Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about gold comparison to the 06-08 cycle. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I've been talking about the 06 and 08 cycle in relation to TLT and really to bonds. I'll make an update about that my next video. I'll see whether to make it straight after this one or probably call it a day. But and really in this video I wanted to talk about gold, because gold is one of those assets that has seen outperformance, and it continues to see it really is the shining star at the moment. And again, as I always say, all right, something goes up, so should you short it? Absolutely not. I won't argue in this video why you should short gold. Absolutely not. I mean, gold will probably continue to outperform, just like it did in 06 and 08, until it doesn't. All right. If we were to follow the manual, of course, we can always throw the manual in the trash can. And what I have highlighted here is what we saw in the 06 and 08 cycle, and really in the lead up to the GFC. And really what you have is a first move up with gold, where it puts in a high, and then it just kind of bobs around, not really doing much for a period of time. Eventually that breaks out, breaks out, pardon me, and it puts in a significant top, which in this case was at just over $1,000. If you go back till today, arguably, you have something very, very similar playing out. You have a run up, put in your first high, then you really don't do much for quite a while. You're just going sideways, a little sideways chop. Eventually, though, you have your breakout. You really have these three phases playing out, which are very similar to something we saw in 2006 and 2008. Eventually, gold kind of goes parabolic, right, and it puts in a significant top. Now, when did gold put in its significant top? In 08. It came on the week of the collapse of Bear Stearns. When Bear Stearns collapsed, you saw gold put in its top, and eventually gold collapsed. Well, really collapsed. It went down, I don't know if you can call it 34%, a 35% a collapse. Regardless, we saw really gold follow suit with basically risk assets in general. And mind you, in the lead up, gold, even back then, was up about 90%. This time around, if I'm not mistaken, it's slightly higher, and it could easily be even higher than, it's about 105% from the lowest point. It could easily just get even well above that. We could easily get to, 3,500. Okay, I'm not arguing that this is the top. Absolutely not. I'm not arguing for you to short it. I'm not arguing for you to, just, sell all your gold, and absolutely not. What I am saying is that gold has the habit, if you look in history, and again, particularly this case, meaning the 06 and 08 cycle, that gold likes to do very, very well in the lead up to what Jamie Dimon would call a kerfuffle. In the lead up to things, bad things brewing, times where things are uncertain, you really don't know what is going to happen. Because again, you kind of had similar mechanics to what we have today. And you might say, we don't have Bear Stearns collapsing today, and you're absolutely correct. But from here till March, we had, for example, right, from really even Bear Stearns, we were at 4% on CPI, down from, up from, its low in 06 of 1.3 on CPI. And we actually went up to 08, which is, and again, I'm not really talking about, the CPI, because again, I've made the case many times before that, we're well past potentially, the inflation fears, in my opinion. But what is similar with what we have today is kind of what I call inflation PTSD. Back then, we actually had high inflation due mainly to oil being, hovering above $100, or its way up to $100. Today, we have inflation PTSD. Everyone is still afraid of 2022, which, could always happen. We could have something crazy occur. Many argue that tariffs will be eventually the culprit. I've been arguing against it, but regardless, I could easily be wrong. I know I'm just a schmuck with with a YouTube channel. But again, coming back to the comparison, what is eerily similar is the fact that we have this kind of stagflationary narrative taking hold, just as we saw back then. If you go and look at what was being written from November of 07, even up till, just a few months before the collapse of Lehman Brothers, there were articles, there were economists, there were, you name it, people were screaming that the Fed would eventually have to raise rates, even after they started cutting rates, even after the cutting cycle had begun, because inflation was at 5.4%, 5.6% in July of 08, just 2 months before Lehman Brothers collapse. And, eventually, we had what we had. So the environment, in my opinion, I continue to make this comparison to 2008, even with bonds. I do believe that a lot of the narratives that surround us currently are quite similar to things that we saw in 2008. Again, the shocks potentially will be different, because again, each cycle is different. I'm not expecting a Bear Stearns, maybe, maybe we'll have it. I hope not. But again, a lot of the narratives, in my opinion, are quite similar. And the price action you see in gold potentially is, again, quite similar to what you saw back then. And again, just to reiterate, why did gold perform so well in the lead up, just as potentially gold has been performing so well in the lead up to potentially something else right now? And it's because of, you don't know what to expect. Gold does extremely well in times of great uncertainty. When you know what you're going into, and what you're going into is a recession, that's when things change. And I will defer to the 06-08 cycle. It isn't a coincidence, in my opinion, that gold topped the week of the collapse of Bear Stearns right here. And as the recession, actually, the recessionary events unfolded, gold followed risk assets. Now, did it have as a terrible time that, the S&P perhaps had? No, I would, if my memory serves me well, I would actually say that, this was greater than a 35% collapse. No, I would say trust but verify. Again, yeah, the S&P actually went down 58%. So was it as a dramatic collapse? No, but gold didn't really protect you in that environment. It protected you in this environment, in the lead up to the unknown. Once you know what is biting you and what it will bite you eventually, that's when gold kind of hands the baton to bonds. And why is that? Well, because, and this is kind of the second part of the video, once you get into recessionary environment, that's when usually deleveraging happens. That's when margin calls occur. And given the fact, excuse me, let's just take this low, right? From June of 06 till March of 08, gold was up 90%. In the lead up to a kerfuffle, all right, gold is, again, and even today, is one of the few winners left. That doesn't mean that everything else is collapsing or everything else is flat. It's just that gold performs extremely well. And this is something that, again, has occurred this time as well. Even today, gold has performed exceptionally well. Exceptionally well. So by the time you get, your margin calls on stocks and, whatever you're holding, and, you've perhaps gotten a bit too tipsy on, on the leverage, what are you going to do? You're going to sell your winners. And when you get into an environment where you have to deleverage, that's when the winner suffers. And actually, gold becomes a source of, liquidity. People sell what has been working in order to raise cash. It's fairly simple. And just to go back to, the bond side of the equation, bonds are boring. This isn't anything new, but bonds actually, they don't really do much until they do everything all of a sudden. And I've pointed this out many, many times. I'll make a video updating, the 06 08 comparison with the 30-year bond. But just to put things into perspective, from 05 till 08, even as, Bear Stearns collapsed, bonds didn't do anything, right? We didn't see anything really substantial in bonds until it was obvious what we were going through, meaning growth and inflation expectation just fall off a cliff. And that's what yields eventually do with time. It is a long process. Bonds are slow. But again, if we are to follow the manual, which again, this type companies will be different, you never say this time is different, but maybe it's, maybe this time is different. You never know. But if you were to follow the manual, gold does very, very well in the lead up. But once you know with certainty what lies ahead, meaning growth slowing down, that is when gold just passes the torch on to bonds. All right. So I'll leave it at that. Is the top in for gold? No, maybe, I don't know. All I'll say, it is looking kind of toppy. All right. That is definitely what I'll say. If I have to, this is just a parabolic move. All right. Now, this doesn't mean that you short it. All right. No, just no. And I'm not calling for a top. I'm saying it's toppy. All right. I'll channel my inner British that's inside me, and it is kind of looking toppy. Whether it goes back, goes further up, or it just stalls out here, that's up for grabs. I wouldn't be shocked in either scenario. But again, if we do get into a kerfuffle, I would expect actually Gaulle to hand off the baton to Bonds. That is, that again, if we, kind of leaving aside the nuclear option, meaning not, nuclear weapons, but Trump actually, channeling, all his best efforts to oust Powell. I think at that point, that's when the manual goes in the trash can at that point. But that is a topic for another video. I'll leave it at that. If you enjoy this kind of content, consider leaving a like, subscribing to the channel, and I'll see you next time. Bye.